All right, we are back with Chapter 9, Features of Common Stock, Stocks Overview. So we have common stock, intrinsic value and stock price, determining common stock values, discounted dividend model, corporate valuation model, other approaches, and preferred stock. Lots of ways to value stocks. So some facts about common stock. It represents ownership. Ownership implies control. Stockholders elect the directors. Directors elect the management. Management's goal is to maximize the stock price. Intrinsic value and stock price. Outside investors, corporate insiders, and analysts use a variety of approaches to estimate a stock's intrinsic value. In equilibrium, we assume that stock price equals its intrinsic value. So we assume that if we buy a stock, that's what it's worth right then. Outsiders estimate intrinsic value to help determine which stocks are attractive to buy and sell. Stocks with a price below its intrinsic value are undervalued, and then if it's over the price, it's overvalued. Direct approaches for estimating the intrinsic value of common stock. There's three listed here: discounted dividend model, corporate valuation model, and models based on market multiples. So the discounted dividend model, value of a stock is the present value of the future dividends expected to be generated by the stock. So these are dividend paying stocks. And this is just time value of money, people. A stock whose dividends are expected to grow forever at a constant rate. So if we know that they pay out 25 cents every quarter, we can figure out their value. It's just time value of money. And we can see future values and their present values. Remember, present value, a dollar today is worth more than a dollar in a year. So we can see the future value of those dollars goes down, down, down. What happens if G is greater than RS? The constant growth formula leads to a negative stock price, which does not make sense. The constant growth model can only be used if RS is greater than G. G is expected to be constant forever. We know that's not true, but it is. If the risk-free rate is 3%, the risk-free mark or the risk for the market is 8%, and beta is 1.2, what is the required rate of return on the firm's stock? 9%, because we have 3% plus 8 minus 3 times 1.2, so we would expect a 9% return. Find the expected dividend stream for the next 3 years and their present values. So we know that the rate should be 9%, growth is 4%, and we have our returns. See this 208, that's how much they're going to pay out, and it's going to grow at 4%, but the present value of that is over here. So what is the stock's intrinsic value? Using the constant growth model, 208 divided by the growth, 0.05, we would expect this stock to be priced around 41.60. What is the stock's expected value 1 year from now? So 1 year from now, it's just the same stuff, different formula. We have the 2.16 this time. It's 43.26. Same formula, just dividends already been paid out, so we use next year's. Find expected dividend yield, capital gains yield, and total return during first year. Dividend yield is just dividend divided by the price, 5%. Capital gains yield is the difference between the price from a year to now, divided by now, 4%. Total return, 5% plus 4% equals that 9% we were looking for. What would the expected price be today if growth is expected to be 0? Now we can see the price goes way, way down because we're not growing our money. And remember, we want this money to grow. So that 9% is going to be worth a lot less. Supernormal growth. What if growth was 30% for year 1, 20% for year 2, 10% for year 3 before achieving long-term growth of 4%? Can no longer use just a constant growth model. However, the growth does become constant after 3 years. So now we just do more math. We just figure out the math to go forward, and we can see here the price should be 71.39 because of the tremendous growth in the first couple of years. Find expected dividend and capital gains yield during the first and fourth years. The dividend yield, 2.6, 4.4, 4.86 here. During non-constant growth, dividend yield and capital gains are not constant, and capital gain yields would not be equal to G. After the third year, the stock constant growth and dividend yield is 5%, and the capital yield is 4%. So we get back to that 9, like we were talking about, non-constant growth. What if G is 0 for 3 years and then 4% after that? It changes things just a little bit. Dividend yield the first year is 5.38. We have our capital gains yield of 3.62. After T3, we go back to the 5 and 4%. You see, still getting to that 9%. It's just the stock price is fluctuating up or down depending on what that growth is, the growth of the dividend. If the stock was expected to have a negative growth, negative 4%, would anyone buy the stock, and what is its value? Yeah, even though the dividends are declining, you're still getting cash. So it does have value, just not the same. Rate minus the growth, that's the rate you want to get, negative 4%. So we got 1.92 in year 2. That's what your dividend would be. Divided by the 13%, $14.77. So find expected annual dividend and capital gains yield. Capital gains yield with a growth of negative 4. The dividend yield would have to be 13%. Since the stock is experiencing constant growth in dividend yield and capital gains yield are constant, dividend yield is a sufficiently large 13% to offset net negative capital gains. Man, hard time talking today. Corporate valuation model, also called the free cash flow model, suggests the value of the entire firm equals the present value of the firm's free cash flow, which is the market value of its operations, plus the market value of its non-operating assets. Remember, free cash flow is the firm's after-tax operating income less the net capital investment. Free cash flow equals EBITDA, earnings before income taxes, times 1 minus the tax, plus depreciation and amortization, minus capital expenditures, plus our non-operating working capital. That is a lot. It's just math. Slow down. Plug each of those in. This is on the income statement. This is on the statement of cash flows. You can do it. So applying the corporate valuation model, find the market value of the firm's operations by finding the present value of the firm's future free cash flows, add the market value of the firm's non-operating assets, subtract the market value of the firm's debt and preferred stock. This is on the balance sheet. This is on the balance sheet or the statement of equity to get the market value of common stock. Divide the market value of common stock by the number of shares outstanding to get the intrinsic value. All this information can be found on the income statement, the balance sheet, and the statement of stockholders' equity. The common stock and the number of shares outstanding, that's on the statement of stockholders' equity. The debt is on the balance sheet. The preferred stock will be on the balance sheet or the statement of stockholders' equity. The non-operating assets, that's on the balance sheet. Present value of the firm's future free cash flows, we found that was a combination of the income statement and the balance sheet. Issues regarding the corporate valuation model, often preferred to the discounted dividend model, especially when considering number of firms that don't pay dividends or when dividends are hard to forecast. It's similar to the discounted dividend model, assumes at some point free cash flow will grow at a constant rate. The horizon value, HVN, represents value of firm's operations at the point the growth becomes constant. So eventually things are going to level off and be normal. Uses the corporate valuation model to find the value of the firm's operations. So here we have long-term growth of 5% and weighted average cost of capital of 7%. So that means 7% there. So here we're at negative 4.63, 10, 20, 21. This is when it gets standard. This is when we're getting ready to have normal growth, the horizon growth. The firm has 40 million total in debt and preferred stock, 5 million of non-operating assets, and 10 million of shares of common stock. The market value of the equity plus the market value of operations plus the market value of non-operating assets minus the market value of debt and preferred stock. We have 877 plus 5 minus 40 equals 842. So the value per share is the market value of the equity. The 842 right there divided by the number of shares is 8425. You can find all of this in the case study on Canvas. The firm multiples methods, analysts often use the following multiples to value stocks: price to earnings, price to cash flows, price to sales. Example, based on comparable firms, estimate their profit price per earnings multiple, this by expected earnings to back out an estimate of the stock price. And enterprise minus base multiples, earning value divided by EBITDA. This is all just different ways to value the stocks. Preferred stock, it's a hybrid security. It's kind of like bonds where you're probably going to get a fixed dividend or it might not pay dividend. It just kind of depends. There's a lot of different ways that firms can have preferred stock, but basically think of it as a cross between stocks and bonds. Some preferred stocks pay dividends, some preferred stocks don't pay dividends, some preferred stocks pay dividends every month, quarter, year, regardless of how much money the company makes. Some pay dividends only when the company makes money. It really just depends on how the preferred stock is set up. If preferred stock with an annual dividend of $5 sells for $100, what is preferred stock's expected value or expected return? 5%. It's just dividend divided by the 100. All right, that is the end of chapter 9. Lots of numbers going this way and that. If you have any questions regarding week 5, after get to work on the homework, let me know how it's going. Please remember, email me early and often so that way I can help you out. All right, talk to everybody later. Bye bye.